Hello, hello, hello. Welcome to Al Stock Trades. In this video, this is going to be by far one of the most important videos I'm going to make as we enter 2023. So listen up. Just understand that this is a lot of information that we have for you here. Now, if you're on the Al Stock Trades podcast, we've been ranking really highly in Italy. I'm very excited for that. Understand that there's images associated with these particular slides here. So please visit YouTube and look at Al Stock Trades, and you'll be able to see the 2023 trends. All right, guys, without further ado, let's go ahead and let's talk about this. So first off, what I want to basically say is, we always say we like to mix fundamental analysis with technical analysis. And a lot of folks, say, Al, I don't really understand this. How do you mix fundamentals and technicals? Because if you speak to the pure fundamentalist, they just say, I just use fundamentals. And then if you go ahead and speak to the pure technicals, they just go ahead and say, I just use the pure technicals. Okay. But in reality, many people use both. In fact, the most successful people use both. And I'm going to show you how can technical analysis give you an edge on the market. Okay. Now, for all of our Mastering Stock Market students, understand that a lot of these diagrams I'm about to show you are already embezzled inside the alstocktrades.com website. There's only a few which we're going to go ahead and program in there. Please enjoy this video. If you have any questions, please comment down because this is very important. All right. All right. So let's go ahead and take a look at our 2023 trends. First things first, let's go ahead and look at stocks versus bonds. So the way we went ahead and did this, we took the Vanguard Total Stock Market ETF and essentially went ahead and aggregated it and divided it over the U.S. Aggregated Bond ETF from the New York Stock Exchange, VTI over AGG. Okay. Now, as you can see here, we have the 52-week simple moving average. And what you can essentially see here is very quite simply. So let's go back to 2020. When we had the 2020 dip, whenever you see red, obviously means down, but whenever you see black, it means the stock, this particular technical analysis parameter is telling you that the stock, this division is going up. So overall, very simply put, you see this blue line here. Whenever the black line or whatever red line, this linear pattern is above this blue line, it's indicating that stocks are going to outperform bonds. And what's interesting here is that you could have honestly just traded this particular here as well as all the other diagrams, and it would have essentially assisted you in outperforming the market and outperforming retail investors that don't know how to look at these particular diagrams and combine them together to formulate your own investment thesis. What we're seeing now is that we started to drop. In fact, we broke an honest breakage point right here on April of 2022. April of 2022 is when we broke the 52-week average, and where, we are like, okay, bonds are going to somewhat dominate and stocks most definitely are going to underperform. So let's go ahead and continue. So we already got one date here, April, and now we're just watching it to see if this is going to trend up. So if you were to go ahead and look at April of 2022, we can go ahead and look at April of 2022. Let's see. Here's April, and already there it is, 71% down. Let's look at Tesla. April of 2022, right there, about 62% down. Okay. So you can use these to essentially help you figure out and use technicals, but there's more. Now we're going to go ahead and look at commodities versus U.S. stocks. So overall, commodities have increased and outperformed U.S. stocks, and they've dropped recently, and now they just basically broke the 52-week moving average. Okay. So we're watching this right now. I'm watching this. I want to know. And there's another graph in here that's going to help determine base metals versus precious metals. And I assume a lot of folks know the answer, but I like to follow data. Now, what did you think this was? You think this was, I'm just going to go ahead and pull something out of my butt to give you a 2023 prediction? No one knows. I like to use data. That's how because there's no emotion in data. And that's how I would like to teach retail investors from an educational perspective to view the stock market. Just pure data, okay? Leave the emotions out the door, okay? Because, Wall Street's going to basically take you for a ride. All right, so let's go ahead and move on to the next graph here. So this is my favorite. Let's look at value versus growth stocks. Okay. So as you can see here, growth has honestly outperformed heavily, especially during 2019 here to 2020, and then value came up. So again, value. So we took the Vanguard value over the Vanguard growth, right? So if you're below the line, growth is winning, and if you're above the line, value is winning. Well, look at this, guys. Value has been outperforming like crazy. Okay, that's why one of the stocks I like to look at is Ernevav. It's an oil tanker company, right? Complete value. In fact, when they dropped heavily in value near 2020, they literally went from $12 down to $7. It was a freak out show. It's like the whole stock market was outperforming, but then they weren't doing well, right, in terms of their stock price, right? Because stock price is obviously equal to the value of the company. I'm joking, right? But what they were doing is they were buying back shares, they were paying off debt, they're increasing their current ratio, and this is the reward. Year to date, they're outperforming the stock market more than 90%, because the stock market is down like, what is that, 20%? So yeah, value play. All right, so as you can see, value stocks are outperforming. Now let's go ahead and look at small caps value versus large cap value. So if you go ahead and look at these things, what you can see here is that whenever the line is below the blue line, large caps growth outperform. Now we're seeing smart cap value outperform. Okay, so we can see the value is above. So what this is telling me is that value is still in the game, which is very clear. Value is dominating over growth, and it is pretty above the 52-week line. So I expect value to continue its trend, and I'm going to be watching it closely to see when is growth going to start picking back up. And let me just be very quite frankly honest with you. A lot of particular retail investors, they love growth companies. They usually coincide with risk on markets versus, for example, if you look at value companies, like, for example, I just showed you this oil tanker company. Like, for example, look at this. Ernevav is a Belgium international shipping enterprise which focuses on oil transport by sea. It's like it's a boring company, and retail investors are like, oh, that's not exciting, right? And that's unfortunately their loss. All right, so if you go ahead and then move on, go ahead and take a look at small caps versus large caps. So 2018, 2019, honestly, right here, the mid 2018, we started to see large caps basically dominate. And all of a sudden, the pandemic happened. The Federal Reserve decreased interest near zero. They started printing so much money, and a lot of particular retail investors saw that small caps, usually their stock prices are under $25 or $30. They went in and shot up that value really high. And then all of a sudden, we started to break down trends. We started hitting upper VWAP lines. We started going ahead and hitting RSIs. And again, this is basically using a macroeconomic perspective and macro technical analysis to help basically shield you from error, especially when you graph this on a macro intrinsic value calculation specified to each of the stocks, right? And then all of a sudden, we had a decrease to where large caps are outperforming. Right now, it's honestly a battle between small caps and large caps. There's no inherent winner. Okay, but what's interesting though is if you go to mid caps versus large caps, you can see that mid caps are actually outperforming large caps, right? Because we're looking at the iShares Core S&P Mid Cap ETF over the SPDR S&P 500 S&P 500 ETF. And what you can see here is mid caps are actually above the 52-week moving average, right? So what does that tell you? Well, there's a prominent theory that's going around in Wall Street, and it's very quite simple. Not a lot of people are focusing on small caps right now. They're focusing on mid caps because they are the ones that have a highest probability to transition into a large cap. And I think it's foolish for retail investors to not look into mid caps and to search through mid caps, and using one of our intrinsic, not intrinsics, but our stock screeners to look through companies that normally have a good, like, for example, current ratio, not too high debt to equity ratio, a good free cash flow of increase of 5 to 10%, with a revenue above 10 to 15%, with a P value definitely under 15. To find essentially a good looking company, especially in the mid cap range, that has some solid prospects. Okay. So it's definitely wise to take a look at this. I'm looking at this very heavily. Okay. All right. So mid caps versus small caps. Okay. So as you can see, mid caps are dominating small caps. And again, the same thing why, we're looking at mid caps versus large caps. All right. And this is kind of the whole Kathy Wood thing, but even though Kathy Wood's kind of all over the place, we're in a transition point right now between mid caps and large caps. A lot of these companies right now, There's going to be a huge transition point. I believe personally, Fang is dead. Innovation is key, and in the next 10 to 15 years, we're going to see some things change. And if you don't believe me, well, then look at 20 years ago. There's a nice circulating post from Twitter that talked about 20 years ago, the way you spent Christmas. You never had an iPhone, you never had Netflix, you never had X, Y, and Z, you never had LinkedIn. And very good thing to keep in perspective to show you how the market dynamics can change. Okay, let's continue. Let's go ahead and take a look at U.S. stocks versus international stocks. Now, quite frankly, honest with you guys, again, this basically takes a look at Vanguard Total International Stocks, which is the top number, right? Which is why it's first here, right? International stocks. My apologies, I put U.S. versus international. It's actually international versus U.S., and it's divided by total stock market ETF. Now, the graph is still good. You just have to read it correctly. So basically, what this is telling you guys, very, 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 very elegantly, is that when the blue line, the 52-week moving average, is below essentially the stock prices are below the 52-week moving average, it's showing you that U.S. stocks are dominating. And it's quite frankly honest, U.S. stocks have been dominating for 15 years. The question of the matter is that how long could they dominate? And for the first time we've seen a big pop-off here between international stocks outperforming U.S. stocks. And if you don't recall, I just made a video recently telling you guys how I essentially called the bottom on the Chinese sector, the Chinese stocks, right? We literally made the video on a Saturday, right literally on the bottom of the market. And if you can look at right now, let's say, for example, look at JD stock. I believe JD is a good example. If you can look at this from October, you can see a big increase. In all the other stocks, you can see humongous increases. They're starting to outperform. And this, you see this little jump right there. This jump is what you see here, right towards about October. So who knows? We might even see international stocks start outperforming, which is something different than what others have felt. That's why it's important to understand the fundamentals of the market. And like all those people that are just continuously buying S&P 500, it's good to diversify. That's why maybe a Vanguard total international ETF would be quite advantageous for the future, because we're starting to see Africa and India come online, especially entering the fourth industrial revolution. But quite frankly honest, the best thing that I like to practice, because in teaching you from an educational perspective, is using intrinsic value calculations and look at comparative analysis to find companies with highly leveraged moats. But go ahead and let's continue. So let's go ahead and let's look at low volatility versus momentum. So what's interesting here, if you look at low volatility versus momentum, for some folks, they're like, what's low volatility? I want you to go ahead and substitute low volatility for risk off markets, and then go ahead and basically look at momentum as risk on markets. Now, I personally use low volatility versus momentum because I like to use these words. They're more academic and just big boys. I don't frankly like this word risk off market or risk on market. I just think this is a purely made up bullshit thing from Wall Street. But quite frankly honest, it is what it is. There are eras of risk off markets and there are eras of risk on markets. Okay, so what you can basically see here is that, again, low volatility underperformed, aka risk off, during the whole 2020 pandemic, when the Federal Reserve decreased interest rates and essentially started to increase the printing power of the money, and essentially gave everyone money. But what's interesting now, we are starting to see low volatility outperform, and we're starting to hit the 52-week moving average. And it's quite frankly interesting to see how this will go into 2023. In fact, out of all of the diagrams I've showed you, this is the one I'm paying most close attention to, because this is going to tell me if we're about to go down. If this breaks the 52-week moving average, stocks are going to outperform, especially more specifically risk on stocks. Okay, so now let's go ahead and take a look at consumer staples versus consumer discretionaries. Again, consumer staples, you can think of it as risk off, versus consumer discretionaries are risk on. So you can see here is staples have outperformed the market really well. But when the Federal Reserve decreased interest rates and started printing a lot of cash, discretionaries were essentially outperforming the market as they were low. And because we took the consumer staples fund divided by the discretionary fund. And again, this is just using technical analysis, simple moving average, which just basically aggregates the data and gives you a little bit of a better way of understanding it. And if you think we're the only ones looking at this, you may be mistaken. You are very mistaken. Wall Street is looking at this heavily right now, and I just want to democratize financial information and teach retail investors how to thrive in a bear market / light to moderate recession, but prepare for the worst for a severe one. So we're looking at this right now. Again, once this consumer staples goes below the 52-week moving average, we can. This will be very good for the market, as retail investors will thrive during markets where stock prices of this particular funds divided against each other is below the blue line, and essentially showing you a risk on market. All right, now let's go ahead, and this is kind of an easy one: technology versus U.S. stocks. Technology has honestly outperformed U.S. stocks, honestly, from 2013 to 2020, 2021, and we go on ahead and saw a break here. So if you had just basically looked at this to all your tech stocks, you would have basically gone out early in time. Right now, the lower this goes, the more ugly-ish things can get, and the more ugly Tesla's going to get. We're going to go ahead and make a separate video on Tesla. I just wanted to go ahead and give you guys this is a very meaty video. There's a lot of video. You might have to watch this again. There's a lot of information here. I'm trying to talk as fast as possible to go ahead and give it to you as fast as I can. Okay, so as this goes lower, technology will essentially underperform. Okay, so now let's go ahead and take a look at energy versus U.S. stocks. Okay, so if you look at energy has underperformed for quite some time. Energy has definitely underperformed, but now in relative to the U.S. stock market, again, we took the energy sector fund divided by the Vanguard Total Stock Market ETF, and what you can see now, finally, we're starting to see that the oil and gas energy is outperforming the U.S. stock market. And I want you to go ahead to my beautiful brother, who was part of our beautiful Mastering Stock Market course. I would like you to remember when Warren Buffett purchased his Oxy shares. Was it during this time? And if he tells you he doesn't look at technical analysis, no, he actually used to look at technical analysis heavily when he was younger. He used to invest in penny stocks. They used to call them pink slips or whatever they call them now, right? So it's quite interesting. If you look at Warren Buffett buys and you place them on this, you might see some similarities. As you can see, this is doing extremely well, and I want to monitor this. Again, if this breaks the 52-week moving average, then we can assume that energy is going to start going down. Now let's go ahead and take a look at traditional energy versus clean energy. This is your favorite stocks for retail investors, ChargePoint and what is it called? I don't know. It's one that does the fast charging. I haven't looked at them in quite some time, but as you can see, clean energy has outperformed traditional energy for quite some time when we are on a risk on market. So it's interesting here. We're starting to see energy, real oil outperform, real energy outperform, right? I want to call it real versus fake, but just kind of make it easy for me to talk and present. What's interesting here is once this breaks the 52-week moving average, I'm going to start looking at those ChargePoint stocks, because I think they're about to set to rally, because as soon as energy basically starts dipping down and we start getting into the clean energy and we look at basically the technology sector starts to basically inverse from the value stocks, and growth stocks start to go higher than value stocks, and you start seeing a transition from a risk off market to a risk on market, that is when we're going to go ahead and shift our portfolios and make extra money. So just go ahead and see that this is all mathematically calculated and you can easily track it. Okay, now let's go ahead and take a look at real estate versus U.S. stocks. Now, real estate has unfortunately underperformed the market for quite some time. Briefly, they went ahead and overperformed. Again, we went ahead and looked at the U.S. real estate ETF over the Vanguard Total Stock Market ETF. And as you can see, real estate outperformed the market here on 2019 and 2020. But then the stock market decimated the real estate market. Stocks outperformed. And all of a sudden, real estate went ahead and came with a huge comeback. And we started to see houses just double. But then all of a sudden, now the Federal Reserve saw this and said, no. We want to go ahead and increase interest rates to slow down the economy and send it to a recession. We can go ahead and break a couple of legs, and we can fix it by decreasing interest rates and doing monetary easing. So now the housing market is starting to go ahead and crash down, as you can see here. Okay, so then one of my favorites, let's go ahead and take a look at base metals versus precious metals. Now, again, I get it. Metals, what is the difference? Precious metals are your gold, your silver, your metals that people love to wear, versus base metals are inexpensive metals used in the industry. Okay, again, industry metals versus precious metals. And as you can see, we took the base metals funds divided by the precious metals funds. And as you can see, when the blue line, the moving average is below, you can essentially see that precious metals dominate. And now we're starting to see industry metals dominate. But hold your horses, hold my beer, guys. Look at here. We're starting to see that precious metals may be coming back. And this is why a lot of investors are starting to look at gold and silver. Keep this in your pockets. Again, this was a lot of information. Whoever stuck around and who's ever going to be watching this information, congratulations. You just know more than 99% of people in the market, okay? Again, we're going to teach you this. I'm going to give you my 10 years of experience. I'm going to show you guys this amazing thing, and I'm going to show you how real Wall Street folks look at the market, okay? All right. So that was a lot of information, guys. A lot of information. And then that's all I have. I'm going to go ahead and close off the video because I don't want to make it even longer. I love each and every one of you guys. It's always a privilege and honor to serve you. And just understand that we do have a holiday special sale for the Mastering Stock Market course. All of these diagrams that you saw will be there with a link where you can click on, and it will show you the updated version so you can continuously check on where the market is, as long as our intrinsic value calculations and all of our softwares and our all stock alerts platform with our proprietary brain machine model. The coupon code is down below. I believe it's New Year something. It's $400 off, one of our biggest sale. We are going to be increasing prices at the going into the next new year as the data and getting this information is becoming more expensive. All right. It's always good. I'm going to look at this really quickly here. Oh, I hear Poland. God bless you. I love Poland. And, I hope one day I can visit it. Pleasure. And I'll see you on the next one.